Welcome back. As we've seen in the early moments of trading, investors are still concerned about that Fed announcement of yesterday, in which the big central bank held its target rate steady while updating quarterly projections showing most officials favored another rate hike in 2023 and that rates could remain, quote unquote, higher for longer. For more on all of this, let's bring in Mike O'Rourke, Chief Strategist at JonesTrading. Mike, thanks a lot for joining us. Should it have been such a surprise to investors yesterday that the Fed is willing to raise rates again in 2023?
I don't think it should have been a surprise in the sense that was already in the Fed forecast. And, Chairman Powell said a majority of the members still see that rate hike coming, in the next two meetings before year end. I think where the market and investors were a little upset was to see that the 2024 and 2025 forecast, so the Fed funds rate, 50 basis points higher at year end for each of those years. And that also really should not have been a surprise because we've had very strong economic data, through July and August. But the Fed obviously is just trying to act appropriately. You didn't see it this morning. We had initial jobless claims that were close to 200,000, which is extremely healthy or strong for the U.S. economy. So, a day later, it looks like the Fed was making the right move as far as showing, reiterating that higher for longer outlook.
And some of the forecasts issued yesterday show that Fed members in the aggregate believe that the Fed funds rate will be around 5.1% at the end of 24. That's higher than the sub 5% forecast that we last heard from the Fed. What's your take on that?
Well, that's a 50 basis point increase from the previous forecast that we received in June. And that's a representation of the Fed acknowledging that stronger economic data, that it's going to take longer to get inflation under control. So from an investor's perspective, now you're sitting here in September of 2023 and looking at the Fed funds rate being up above 5% for the next 15 months. And the 5.125% forecast for the end of next year is only 25 basis points lower than we are today. So you really are starting to, that really crystallizes what higher for longer means for investors. And what you're seeing, that reaction in the stock and bond markets this morning, the 10-year Treasury yield is closing in on 4.5%, new 16-year highs. And obviously the stock market's under pressure due to those tighter monetary conditions.
What sectors of the U.S. stock market do you believe can prosper, can do well in this type of macro environment?
Well, I think people.
Okay, we have lost our
led
connection.
Primarily by seven. Hello?
Yeah, you froze up briefly, Mike. If you can still hear me, go ahead. Just complete your answer there. We missed the early portion of your answer. What type of sectors in the U.S. stock market do you believe can do well in this macro and rate environment?
So basically, I think investors want to be defensively positioned. We've had a very strong run for U.S. equities this year, driven mostly by 7 mega cap names. So I think you want to look at the value type stocks. I continue to like the financials, but you want to look at places that are going to be a little more defensive going forward. And I think interest rate sensitive names are probably a little the worst is behind them now that we're just about at the end of rate hikes. So I think that risk is already priced into those names at this point.
What about the energy stocks? They have done very, very well in the U.S. and in Canada on this oil price rally we've seen. What's your call there?
They've done great. They fit into that value category because they all trade at attractive multiples. The big risk going into next year is going to be this tighter monetary policy start squeezing the U.S. economy and global economies for that matter? And do we start to see the big gains in energy slow down? I don't think we're there yet. So I think oil still still in the midst of this bull run, but we have to be worried about it getting a little long in the tooth as we go into next year.
And on the financials, do you prefer the big Wall Street money center bank stocks? Because the regionals are, they're cheaper than they used to be, but there's a reason for that. They still have not recovered from the Silicon Valley Bank fiasco.
Exactly, Paul. I totally agree with that. I think the regionals represent more risk. And as you said, they're cheaper than they used to be. I wouldn't really necessarily run away from them, but the big Wall Street banks are far more attractive. They represent value, and they are key players to the U.S. economy and the global economy. So I think that's where I would focus.
Any thoughts on the price of gold, which has disappointed gold investors this year, has not been able to break above 2,000 and stick there?
Well, I think the problem with precious metals in general is these rising interest rates it's occurring globally, and now they're finally starting to you're finally starting to feel it in the markets. So you had a big upward reversal in the dollar yesterday, after the FOMC meeting, and I think we're going to see more of that. And we're looking at a situation where other central banks are all basically at that pause point as well. So if we're looking at rates being higher in the U.S., monetary policy feeling tighter in the U.S., it's going to put downward pressure on precious metals.